Let's say you work hard, you save, you don't blow money on things you don't need, you do everything right, and yet, somehow, every month, money disappears. Not in big chunks you would notice, in small, automatic, almost invisible drips. Your budgeting app says you're on track, your subscriptions are just a few dollars each, your 401k statement shows steady growth, and you look at the numbers and you think, am I just bad at this? You're not bad at this. There are three mechanisms, legal, deliberate, and hiding in plain sight, that transfer wealth out of your pocket every single year without ever asking your permission. They show up on your statements, you agreed to them, and the companies that benefit have very little interest in explaining how they actually work. Today, we're going to explain all three. It starts with the tool you were told would fix everything, the AI budgeting app, the smart financial assistant, the algorithm that promises to optimize your spending, find hidden savings, and finally make you good with money. Here's what they don't advertise. In 2025, researchers tested the most popular AI financial tools on real-world questions. Should I buy this house? Can I afford this car? What's a reasonable engagement ring budget? The AI gave incorrect answers 44% of the time. On major life purchases, houses, cars, rings, it was wrong 70% of the time. Not slightly off, dangerously wrong. Recommending payment plans that would leave users insolvent. Calculating affordability without accounting for taxes, insurance, or maintenance. Treating complex, emotional, long-term decisions as simple math problems. And here's the deeper issue. These apps are trained on data from people who are already struggling. They learn patterns of scarcity and normalize them. If most users in their database carry credit card debt, the AI learns that carrying debt is standard behavior. It doesn't tell you to stop. It tells you how to optimize around the debt. It doesn't teach you to build wealth. It teaches you to manage broke slightly more efficiently. You were sold a financial coach. You got a pattern matching engine that keeps you in the ecosystem, generating data, watching ads, paying subscription fees for the privilege of being told you're on track. This is not a bug. This is the business model working exactly as designed. Now, let's add the second layer, because this is where it gets genuinely uncomfortable. The subscription economy was not built for your convenience. It was built for your inattention. In 2025, nearly half of all subscription revenue, 47%, now comes from weekly billing plans, not monthly, weekly, because the psychology is well understood. A smaller number feels safer. $7 a week sounds manageable. $364 a year sounds like a commitment. The same product, the same total, but one framing exploits your brain's preference for small, frequent losses over large, visible ones. The industry has a term for this: psychological safety. They are literally designing the billing cycle to bypass your rational assessment of value. And then there's the cancellation friction. In July 2025, regulators tried to enforce a simple rule. If you can subscribe with one click, you should be able to cancel with one click. The rule was struck down. Companies can continue requiring phone calls, retention specialists, multi-step processes, and "are you sure" confirmations specifically engineered for you to give up. Not because the product is valuable, because they know that by the time you reach the third confirmation screen, you'll feel the loss aversion kick in. You'll worry about losing your playlists, your watch history, your saved preferences. You'll stay subscribed to something you haven't used in months. The average household now has 23 active subscriptions. Most people cannot name more than 12 if asked. The rest are quietly extracting money from accounts you stopped monitoring, for services you stopped using, under billing cycles designed to feel harmless until you finally add them up. You are not forgetful. You are being harvested. Here is the quiet irony at the center of this whole thing. The financial advice industry, the books, the podcasts, the YouTube channels will tell you the solution is to invest. Put your money in index funds, max out your 401k, let compound interest work for you. And they're not wrong. That advice is correct. But notice what they rarely mention: the mechanism inside that 401k that works just as hard as compound interest, but in reverse.
Fees. Not the expense ratio you can see, the administrative fees buried in the summary plan description, the investment management fees deducted before you ever see a return, the revenue sharing arrangements between your employer's plan and the fund providers. In 2025, the median 401k plan charges 0.75% annually. The worst plans charge 1.45% or more. That difference sounds small until you run it across 30 or 40 years of compounding. A worker in a high-cost plan retires with approximately $559,000 less than someone in a low-cost plan. That is not a typo. Over $500,000 gone, not to market losses, not to bad investments, but to fees so poorly disclosed that 2/3 of participants don't even know they're paying them. The industry relies on this invisibility. They know that if you understood the math, you would demand change. So they hide it in 6-point font, in documents you never receive unless you ask, using language designed to make your eyes glaze over. You are not bad at investing. You are participating in a system where the house takes its cut before you even place your bet. Let's zoom out even further, because there's a bigger pattern that doesn't get named enough. These three mechanisms, the AI advisor that keeps you managing scarcity, the subscription cycle that exploits your inattention, the retirement plan that hides its costs, are not separate problems. They are the same logic applied to different domains. Find the point of maximum leverage in someone's financial life. Insert friction, opacity, or false confidence. Extract value slowly enough that it never triggers a crisis response. Repeat across millions of users. This is not conspiracy. This is incentive architecture. When companies are paid by engagement, they optimize for engagement. When they are paid by assets under management, they optimize for assets under management. When they are paid by recurring revenue, they optimize for recurrence. Your financial well-being is a side effect. Sometimes it aligns with their interests. Often it doesn't. There have been historical moments when this architecture became too visible to ignore, when the gap between what people believed about their money and what was actually happening grew too large. Weimar Germany in the 1920s, when savings became worthless between breakfast and dinner. Argentina across decades, where the middle class learned to convert paychecks to dollars within hours of deposit. The 2008 financial crisis, where complexity itself became the extraction mechanism. In each case, the people who suffered most were not the reckless, they were the dutiful, the ones who trusted the system because it had always worked, who believed that following the rules would protect them, who never thought to ask whether the rules themselves had been rewritten while they weren't looking. None of this means you should panic. None of this is a prediction. This is an audit. The purpose of understanding these mechanisms isn't to become cynical or to start stuffing cash in your mattress. It's to make specific decisions with clear eyes. Delete the AI budgeting app and build a spreadsheet you control. Audit your subscriptions this weekend, every single one, and cancel what you haven't used in 30 days. Find your 401k's fee disclosure, calculate your all-in cost, and if it's above 1%, demand better options or roll over to an IRA you control. The question worth sitting with, the one that I don't think has a clean answer, is this. If the financial system depends on most people not examining these mechanisms too closely, what changes when they do? Do the companies adapt, find new forms of opacity, new interfaces of friction, or does understanding actually change the balance of power? Because here's what's interesting. Every generation that has faced this question has mostly chosen to protect themselves individually, to learn the rules, however flawed, and play better, to opt out where possible, minimize exposure where not, and build resilience without waiting for the system to reform. That's a reasonable choice. It might even be the right one, but it's worth knowing that you made it, rather than having it made for you.